Well, as mentioned at the top, we are going to be talking about the state of state-owned enterprises. We do understand that we are nearing at the end of the session, which is meant to finish at 11:30. So we are running a few minutes over. For those of you who can continue to watch us, please do stay with us. Alternatively, of course, this will be made available to you. Now, joining us again from Johannesburg, we have Jones Gondo, excuse me, and he is a senior research analyst for credit at corporate investment banks, and he will be talking to us about the state of state-owned enterprises. Jones, I know that you have had a look or a listen at what Nikki had to say in terms of state-owned enterprises. I think one of the things that she said was that they lack the skills to be able to power through. Of course, when we think about state-owned enterprises, unfortunately, problem children come to mind, but perhaps you can kick us off and then we'll have a look at some of your insights.
Thanks, Tumi. It's really, if you look at this slide in front of you, it's a complex set of companies, right? If you were National Treasury looking at this portfolio, you're looking at skills that are required to understand how to govern huge companies across many industry verticals. And I think, the institutional arrangement is what government and its policy thrust is focusing on right now, which is kind of removed from operational issues that we can jump into in a bit. But what is complex about it is that a lot of these companies are customers to each other, and a lot of our major industries are key off-takers and customers to many of these institutions. And what I want to take away from this is what's happening right now is that in energy and surface transport, so Transnet and ESKOM, there's basically reorganization happening, and these plans have been there for ages. But we feel that we're starting to make some headway in steps towards streamlining and creating those efficiencies that Nikki was talking about. And just to highlight a couple more is just, the DFIs sit at the center of government's thrust to basically use capital to drive growth, but their size and scale just lacks the aspiration government has for them. Their capital base they can't make the step or the leap that government intends for them. And finally, I just wanted to point out that there is disruption happening in the business, and the best place to see it is in mass transit, where road mass transit is essentially privately run. If you think of the taxi industry, and the fact that the shift to go to rail is something that is a big focus for Transnet and for PRASA, and SANRAL continues to have trouble in Gauteng. I'll leave it there. Back to you, Tumi.
Fact that when we think about state-owned enterprises, one would be forgiven again for thinking that they are problem children, but I don't think maybe enough focus is spent on looking at the different avenues that they can actually play a meaningful role in lifting economic growth. I mean, we've got the procurement process, which is just one of the ways in which we can have state-owned enterprises draw in those groups that have been excluded from economic activity.
Yeah, one of the things you're right about crowding in effect, but I think, if we take a step back and we just think about, some of the viability issues, government policy kind of assumes business as usual, that these entities are not in financial distress. But it's a circular argument on the first instance, is that the government wants to create growth and they want to use infrastructure and SOEs at the center of that thrust. But because they're not in good financial standing, they actually require the economy to uplift, so the real economy to do the heavy lifting, for them to be viable and to play that role. And so I think the focus really needs to be on the private sector and crowding them in to sort of break that cycle. But also I wanted to mention, something I alluded to, is that at the center of some of the credit transmission risks is that municipalities face the real economy as customers. Think of your utility taxes, levies, etc. But they pass on that revenue is meant to pass on to ESKOM on the energy side, DFIs lent to municipalities. If you think about water and sanitation, bulk water, and so and we know the revenue issues and the governance issues at municipal level. So unless we really focus, well, if the government really focuses on that municipal sector, we're continually going to have revenue losses and shortfalls.
I think that will bring you to your next point, Jones, because as you mentioned, we have seen state-owned enterprises that are just too reliant on government funding. This was actually highlighted in the budget review after the tabling of the budget this year by Finance Minister, in that this is simply unsustainable. At some point, they need to be able to generate their own revenue.
Indeed, and I think this chart really hits it home for me. Is that similar to the sovereign, if you are unable to create earnings growth above your cost of debt, you're going to have a big liquidity problem, and it's the gap is not closing at the moment. So a lot of the operational efforts, and if you want to hold management teams accountable in their strategy, it really has to look at a catalyst for revenue growth. And obviously, like I said, the real sector as the main customer, if GDP continues to pump along, then this will shift on the revenue side for them. But that also assumes that in some of the disruption that there's no substitution effect, that customers can't look to alternative services now. If this process is just too slow. And the one thing that is most recent that we'll be looking at especially for ESKOM and SANRAL, is the amount of their bad debt book. We know that the proportion of doubtful receivables is climbing, and that means there's no cash flow coming in. So this is the structural issue at hand for those of us who are looking at the sources of revenue and how they're going to deploy or manage capital going forward. I think also the last thing to really mention is that I've mentioned many times to many market participants that we in a classic zombie firm structure, right, where the definition of it is that your net income margins are negative and your cash cover ratios are below 1. And for the next decade, this is not going to shift until we do some of the fundamental reforms to operations. So for those entities that are embarking on reorganization, we need to understand, number one, the efficiency and whether that actually improves operating leverage, because they have high fixed capital bases or fixed cost bases in these businesses.
Jones, it was actually a very interesting point that one of our speakers mentioned. I think it was Jan Frederick from Fitch Ratings, and when he was looking at the state, the state of state-owned enterprises, he said, surprisingly, it's not about the leverage. It's just the fact that state-owned enterprises in South Africa have weak financial positions.
Yeah, this really does speak to that. Because you can hold a specific debt burden, and if you are a monopoly or you are a regulated monopoly, you should be able to spread that cost out to all users. But clearly, when you're in a liquidity crunch, it's the debt burden stops being, you stop looking. If you just look at this debt maturity profile, you stop thinking about the debt in 2023, 2020, 2036, and all you have to worry about is what's right up in front of you today, because that's where the liquidity crunch is. And so for us, if you think about all the entities outside of, say, ESKOM and Transnet, there isn't actually a big listed debt burden out there, relatively speaking. So it really is about, for the rest of the SOEs in the portfolio, let's look at the weak operational capabilities. And if it's not about cutting debt and fixed costs, they need to look at the revenue side. And I think that's what a lot of people should take away, is that if we were to distill all the issues, it really is about creating that operational leverage. And we also see it in the fact that business rescues do not result in closing that gap.
They say that one should never waste a crisis. We have seen that there has been a particular institution that has defaulted on its debt, and the National Treasury had said that there were increased risks that we could see other institutions also default on their debt. But what are some of the lessons that can be learned from some of the institutions who have either had to go through business rescue or where we have found or seen some defaults?
Yeah, we've seen Landbank, SAA, currently, Denel's in a real bind. But I think what we can really take out of Landbank's process is that, extraordinary support from the sovereign is limited. They changed their guarantee framework requirements in the middle. And so guarantees in the future are only going to be for the developmental mandate, so for growth capital, what it means is that the support coming, be it by way of guarantee or equity injections, is conditional, right? And if you think about it in a bank point of view, if you have capital that is not loss absorbing, that doesn't protect senior unsecured, that equity injection is not there to absorb loss. It's there for growth. And I think for the domestic investors is that, look, at the end of the day, the international comparison is that we lack investor representatives to really take the collective rights of investors and push the sort of debt default resolution process to be a lot quicker. On SAA side, it's just really there was a lot of political interference, because if you think about the role of a business rescue practitioner, they're either reporting to CIPC or the High Court, not to the shareholder. And I think the point is we're still waiting to see if privatization can actually take root and see what kind of strategic equity partners actually step up to the plate and what their strategy is. But ultimately, some of the conflict I do see is that shareholder departments and National Treasury kind of see this process differently. Especially when we consider that the elephant in the room is ESKOM, their just transition process at the end of the day needs to translate not into political rhetoric only, but also into their business strategy with some specificity in there about what it means for their operating model. We're seeing that process in ESKOM's unbundling at the moment, but we will see how measurable that will be in the long run.
I suppose that's a good point or a good place to just close off, Jones. But your final thoughts there in terms of ESKOM, a turnaround in their debt management in, say, the next year or year and a half. Are there any positive signs or signals that we can see from that state-owned enterprise? I think it is understandable where a lot of people at the moment are not very happy with that particular institution.
Yeah, no, I mean, I think that's it just depends on where you sit and where you stand. If currently in load shedding, stage 2, a lot of us are unhappy. But I think let's just take a step back and think about the just transition mandate. It's, at one hand to slow the process of change, because the big change coming, and that's really at their doorstep, is climate change and the fact that they need to decarbonize. And they need to do it whilst maintaining some revenue. But government doesn't really want them to cut costs via the retrenchment route. So it's a tricky balance for them. There's still no debt resolution in place. And just to reiterate some of the things I said before, their special appropriation they've got is conditional, right? So the unbundling is one of the key milestones that they need to get more capital. But given that it's systemically important, even if they don't meet those targets, government still has to pretty much inject capital for debt service. The board has been insulating the company from political interference. If you just think about the fact that they're following a lot of their legal rights through, be it on changing expensive contracts or renegotiating them, be it taking NERSA to court to really get the full tariff that is cost reflective, or even simply just trying to root out the corruption that was endemic. But I think to sort of wrap it up in terms of them doing reasonably well is that they are chasing revenue. They're going for revenue collection, almost garnishing municipal accounts. I think the point for me is that they've got a decommissioning strategy for their old fleet, their old coal fleet, but because under climate risk standards, they are the scope 2 risk for all entities in South Africa. We need to see the pathway for how their emissions go down a lot quicker than they've set. And I think the Presidential Climate Change Committee has a lot of input into this process. And I think just to wrap it up, to give you some perspective, we think the debt needs to be solved within the next 12 to 18 months because the bailout schedule that National Treasury has put out doesn't necessarily cover absolutely everything over the next 10 years. So something needs to give in the short term. And I think if nothing happens, they just have to front end some of the bailout that is in 26, 27 and bring it forward. And the last point to make is that, how should they approach this debt? There are few strategies being bandied about. We preferred the swap ESKOM debt into South African government bonds if that was a plausible scenario. I think a lot of investors would prefer that, obviously, because it's value. But National Treasury, I think, doesn't want to crystallize the debt onto the balance sheet. And for that, an SPV solution that shifts the debt off balance sheet seems to be the compromise solution. Why is it a compromise solution? Simply because it doesn't remove the liability from ESKOM's balance sheet. It's still their debt, but it's being serviced by someone else, and it's not officially on the sovereign's balance sheet. So it's a happy medium. A debt for equity swap for me is being spoken about, but it's complicated. It will be a distressed exchange default, according to rating agencies. And also it requires that, some investors who can't hold equity, they just fixed income investors to hold equity. PIC doesn't hold everything, right? And I think the chart at the bottom shows that, of all that debt that ESKOM is holding, that PIC is holding, some of the bonds are not where PIC doesn't have a super majority. So I think at the end of the day, ESKOM just wants the debt service lowered so that they can deploy capital where it really matters, which is the transition to get to 40% renewables by 2030.
Jones, thank you so much for those insights. Unfortunately, we're going to have to stop it there in the interest of time, but really some great insights from you. That was Jones Gondo. He is a senior research analyst for credit at Nedbank CIB. That brings us to the end of the session. Again, great apologies for being over time. Just before we wrap up, a very big thank you to Ian Ferguson. Of course, he is the head of distribution at Nedgroup Investments Cash Solutions, and of course that collaboration that Nedgroup Investments and Nedbank Corporate Investment Banking has had, welcoming Francis with us today and sharing his insights on what is happening in that particular area of the business. Tomorrow we will be kicking off our final day in the coverage of the Treasurers Conference. Lots to look out for. Again, we'll have commentary coming through from JP Landman. So again, some interesting thoughts there. Then we'll have our resident behavioral economist who'll be talking about those investment biases. So I'm pretty sure you won't want to miss that. Before we go, just the usual. We do want to hear from you. Do give us your thoughts and insights on what we could do, what you'd like to see more of or less of. How this works is, at the moment, you'll have a QR code on the screen. You take out your cell phone, put it to your screen, and a quick survey will come up. We definitely would appreciate even more of your time. But until then, I'll be seeing you tomorrow, and have a great day.